Hello, in this section we will take a look at the adjusting entries, the creation and interpretation of the financial statements, the closing entries and reversing entries in the three accounting software, including QuickBooks Online, QuickBooks Desktop, and Excel. This looks like a lot of information, and it is, but the amount of information will be about the same or less than we've seen in some of the first and second month of operation sections. The adjusting entries are going to be those processes that will be needed in order to make sure the financial statements are as close to an accrual basis as of the time they are being generated as possible, meaning the financial statements are typically going to be most useful as of the end of the month or the end of the year. That's when we're going to need them in order to present. That's when we often want them in order to interpret future information and will be needed for other types of uses as well if we want to get a loan or for our taxes or things like that. As of those point in times, we want to make sure the financial statements are as accurate as possible so that we can make the best judgments on them as possible. In order to do that, we set up the system so that we have some adjustments to put us better on an accrual basis. These adjustments are typically going to be things that will be more theory-based, meaning they're going to be conceptually more difficult than a lot of the data input types of transactions because they will deal with accrual principles. There are also types of things that we often have help with within the accounting department if we're a small business or any business. Often a separate department or a CPA firm would help with the adjusting entries process. Because there's something that happened at the end of the time period as well, there's not a typical kind of format, a kind of form. There's not something like an invoice or a bill or a sales receipt that we can just put in place that QuickBooks has in place to do the adjusting process. We will typically need to use some types of journal entries even in the QuickBooks system, and therefore typically need to know some debits and credits in order to do that. Within Excel, of course, we will enter these adjusting entries and we'll be using a worksheet instead of our normal worksheet that posts to the general ledger, and that'll give us a real good idea of what is happening directly to the financial statements and the trial balance from the adjusting process. Then we're going to create the financial statements. Of course, in QuickBooks, we can just generate the financial statements once we have entered the data. The point here is that the financial statements now, after the adjusting process, should be as accurate as possible. And once we generate the financial statements within QuickBooks, we'll also take a look at the creation of the financial statements in Excel. And we'll get a more detailed look in terms of what QuickBooks is doing, all this information that we have put in the process, the 2 months of information, the adjusting entries, how is QuickBooks taking that information, those forms, and generating financial statements. We will have already looked at the creation of the trial balance through the Excel sheet now, and now we're going to use that trial balance and directly see how the financial statements will be generated from it. Then we'll do the closing process. QuickBooks is going to be an area where the closing process is basically done for us for the most part, meaning QuickBooks will close out temporary accounts and start the new process basically automatically if we set the system up correctly. But we need to know what to do, what's going on with the closing process in order to set the system up correctly and in order to interpret reports. And that's, of course, what we'll do in Excel. We'll go through that closing process, which we will have to do in a more manual basis within Excel. And in so doing, we'll say, oh, okay, this is what's going to happen when I create, say, an income statement from one period to the next period. How is QuickBooks going to close that out? It also gives us a much better idea and relationship between the balance sheet and the income statement. The closing process is going to be something that happens kind of at the end of the cycle. This is at the end of the accounting cycle. After the main event has happened, after we created the financial statements, we then do the closing process to basically set up for the next time period, for the next month, the next year. Then we'll talk about reversing entries. These are going to be things that typically we make as of the first day of the next time period. What we're reversing are adjusting entries, only some of them, however. And we'll talk about why we would want to reverse adjusting entries, what's the purpose of the reversing entries, what are the pros and cons of using some types of reversing entries. And one of the main things we'll have there is that the reversing entries will help us to separate from the adjusting department from the normal day-to-day process within the bookkeeping, and therefore not allow our adjustments at the end of the time period to interfere with the normal day-to-day input process. So we'll discuss which accounts need reversing entries and how those reversing entries could be input into both QuickBooks Online, QuickBooks Desktop, and then we'll see that same process, of course, in Excel, which will give us an idea of some of the inconsistencies that actually happen when we do the reversing entries and then be able to analyze the pros and cons of the use of a process like the reversing entries.